It's great to have you here once again as we continue our journey through this audiobook and video training series based on my book, Forex Trading Fundamentals, a complete beginner's guide. By now, you've learned how the Forex market works, how currency pairs move, and how price action reveals the story behind every chart. Now it's time to move deeper into the tools traders use to interpret momentum, strength, and potential future direction. Welcome to Chapter 5. Introduction to Technical Analysis. This chapter is one of the most exciting and practical parts of your Forex education. Here, we begin exploring the indicators, tools, and chart patterns that professional traders use every day to confirm trends, find entries, and refine decision-making. Here's what we'll be covering in this chapter. 1. Indicators Overview, RSI, MACD, and Moving Averages. We'll begin with the most widely used technical indicators in the world. RSI, which measures momentum and overbought/oversold conditions. MACD, which helps identify trend strength and shifts. Moving averages, the foundation of trend-following strategies. You'll learn how each one works, when to use them, and what they reveal about the market's energy. 2. Fibonacci retracement and extensions. Next, we'll explore the famous Fibonacci tool, used to identify potential pullback zones, trend continuation areas, and profit targets. You'll discover how traders use fib levels to anticipate market reactions with surprising accuracy. 3. Chart patterns, triangles, head and shoulders, and flags. In this section, you'll learn some of the most powerful chart patterns in technical analysis, formations that signal reversals, breakouts, and trend continuation. These patterns occur again and again because they reflect human behavior in the market. 4. Combining indicators with price action. Finally, we'll learn how to combine everything you've studied so far: indicators, support/resistance, chart patterns, and raw price movement into a cohesive trading strategy. This is where technical analysis becomes a powerful confirmation tool instead of a guessing tool. By the end of this chapter, you'll understand how to use technical analysis the right way. Not as a shortcut, but as a method to add structure, confidence, and precision to your trades. Before we get started, don't forget to subscribe to the TheRockFXHub, like this video, and share it with anyone learning Forex. Make sure you turn on notifications so you'll be alerted the moment I upload the next chapter. So grab your notebook, get comfortable, and let's explore the powerful world of technical analysis. Welcome to Chapter 5, Introduction to Technical Analysis. Section 5.1, Indicators Overview, RSI, MACD, Moving Averages. Page 1, Introduction to Technical Indicators. Technical indicators are mathematical tools used to analyze price data and help traders make informed decisions. While price action reveals the raw story of the market, indicators help measure that story, showing strength, weakness, momentum, and potential reversals. They are not magical prediction tools, but rather instruments that help traders interpret market behavior with more precision. The most widely used indicators in Forex include the Relative Strength Index, RSI, the Moving Average Convergence Divergence, MACD, and Moving Averages, MA. These indicators are considered foundational because they work across all currency pairs, all time frames, and all trading styles. Whether you are a day trader, swing trader, or long-term investor, these tools provide clarity and structure. Before diving into each indicator, it is important to understand what indicators cannot do. They cannot remove uncertainty from the market. They cannot guarantee wins. They do, however, offer probability-based insights, helping traders filter noise and avoid impulsive decisions. Indicators are often grouped into categories such as 1. Momentum indicators, e.g. RSI. 2. Trend indicators, e.g. moving averages. 3. Trend strength indicators, e.g. MACD. Each indicator extracts a different perspective from price data. Momentum indicators help identify overbought or oversold conditions. Trend indicators help determine the direction of market flow. Oscillators like MACD help identify potential shifts in direction. It is also essential to understand that indicators lag behind price because they are derived from historical data. This lag is not a weakness, but a reflection of how they process information. Their power comes when combined with price action, support/resistance, and session timing. This section explains RSI, MACD, and moving averages in detail, showing how they work, how to interpret them, and how they fit into real-world trading. Page 2, Relative Strength Index, RSI, how it works. The Relative Strength Index, RSI, is one of the most widely used momentum indicators in Forex trading. Developed by J. Wells Wilder, RSI measures the speed and magnitude of recent price changes to determine momentum strength. It oscillates between 0 and 100, making it easy to interpret visually. The classical interpretation is 1. Above 70 equals overbought. 2. Below 30 equals oversold. Overbought does not mean price must fall. It simply means buy momentum is strong and may be losing steam. Oversold does not guarantee a reversal either. It simply means sellers have dominated and momentum may be slowing. RSI is most powerful when combined with trend direction. 1. In an uptrend, RSI frequently reaches 60 to 70 and rarely drops below 30. 2. In a downtrend, RSI often remains between 30 to 40 and rarely exceeds 70. This trend-based interpretation helps filter false signals. Another powerful RSI tool is divergence, which occurs when price makes a new high, but RSI fails to make a new high, signaling weakening momentum. Bullish divergence happens when price makes a lower low, but RSI makes a higher low, suggesting sellers are losing strength. Divergence does not predict immediate reversals, but offers early warning. RSI can also be used for market structure confirmation. When RSI breaks its own internal trend line before price does, it can indicate an early shift in momentum. Traders should avoid using RSI in isolation. It is most effective when paired with support/resistance, candlestick signals, and moving averages. RSI's strength is clarity. It simplifies momentum into a single number while reflecting real trader behavior, exhaustion, acceleration, and emotional swings. Page 3, MACD, Trend Strength and Momentum Shift. The Moving Average Convergence Divergence, MACD, is a trend-following momentum indicator developed by Gerald Appel. It measures the relationship between two moving averages, the 12-period EMA and the 26-period EMA, and plots the difference as the MACD line. A second line, the 9-period signal line, is then used to identify crossovers. MACD has three key components. 1. MACD line shows the difference between 12 EMA and 26 EMA. 2. Signal line, a smooth version of MACD. 3. Histogram shows the distance between the MACD line and signal line. MACD provides three main types of signals. 1. MACD signal crossovers. When the MACD line crosses above the signal line, it suggests bullish momentum. When it crosses below, bearish momentum strengthens. 2. Underscore zero line crossovers. When MACD crosses above the zero line, it signals a shift into an uptrend. Crossing below the zero line indicates a potential downtrend. 3. Divergence. MACD divergence is considered one of the strongest signals in technical analysis. 1. Bullish divergence. Price makes a lower low, but MACD makes a higher low. 2. Bearish divergence. Price makes a higher high, but MACD makes a lower high. MACD is particularly useful on higher time frames, for H daily, because it filters noise and highlights the underlying trend strength. The histogram provides early hints at momentum shifts even before the crossover occurs. However, MACD lags due to its reliance on moving averages. It is best used to confirm trends or to warn of weakening momentum, not for entering trades blindly. Traders often combine MACD with RSI and price action to form robust trading systems. Page for moving averages. Trend direction and dynamic support. Moving averages, MAs, are among the simplest yet most powerful indicators in Forex. They smooth price data to reveal the underlying trend and remove short-term noise. The two most common types are simple moving average, SMA, exponential moving average, EMA. SMAs apply equal weight to all price periods, while EMAs give more weight to recent prices, making them more responsive. Popular moving averages are 20 MA short-term trend, 50 MA intermediate trend, 100 MA long-term trend, Quetzalsmont macro trend. When price is above the moving average, the trend is considered bullish. When price is below it, the trend is bearish. MAs are also used as dynamic support and resistance. Price often pulls back to the moving average before continuing in the trend direction. Golden cross and death cross. Two famous MA signals are golden cross, when the 50 MA crosses above the 200 MA, bullish. Death cross, when the 50 MA crosses below the 200 MA, bearish. These signals are widely used in institutional trading. MA slope, the slope of the moving average, is as important as its position. A rising MA indicates trend strength. A flattening MA signals potential consolidation. A downward MA reflects bearish pressure. Moving averages are excellent trend filters, but poor standalone entry tools. They work best when combined with price action patterns, RSI momentum, or MACD confirmation. Page 5, audiobook version, How to Explain the Table Clearly. When comparing RSI, MACD, and moving averages, it helps to think of their differences the way you would read a table with columns and rows. Since you're listening in audio format, I will guide you through this table step by step so you can picture it clearly. Imagine a table with 4 columns, and each column has its own heading. The first column is indicator. The second column is best for. The third column is strength. And the fourth column is weakness. Now, this table has 3 rows, 1 row for each of the indicators we're comparing: RSI, MACD, and moving averages. Let's walk through each row one at a time. Row 1, RSI, indicator. RSI, the relative strength index. Best for, measuring momentum. It helps you see when the market is potentially overbought or oversold. Strength. RSI is very clear and easy to read. It gives strong signals about momentum exhaustion. Weakness. In strong trending markets, RSI can give signals too early. For example, it may show overbought while price continues pushing upward for a long time. Row 2, MACD, indicator. MACD, the moving average converges divergence. Best for, reading trend strength and spotting shifts in momentum. Strength. MACD is excellent at showing when momentum begins to fade or reverse. Its histogram visually highlights early momentum changes. Weakness. MACD lags behind price because it's based on moving averages. This means signals may arrive late, especially in fast-moving markets. Row 3, moving averages. Indicator. Moving averages, including the 20, 50, 100, and 200 period averages. Best for, identifying the overall trend direction. Strength. They filter out noise and make it easier to see whether the market is trending up, trending down, or moving sideways. Weakness. In choppy markets or ranging environments, moving averages become less reliable and may give mixed or whipsaw signals. Understanding how these indicators work together. Now that you can visualize the full table, let's look at how traders combine these indicators. Combination 1, RSI and MACD. RSI reveals momentum strength. MACD confirms trend direction or upcoming reversals. Together, they help identify whether a trend is slowing down or gaining steam. Combination 2, moving average and RSI. The moving average shows overall direction, uptrend or downtrend. RSI shows whether the market is temporarily overbought or oversold. This helps traders spot pullback entries in the direction of the trend. Combination 3. Moving average and MACD. The moving average identifies the main trend. MACD identifies when momentum aligns with that trend. This combination is especially useful for trend-following strategies, when each indicator works best. RSI performs best in quiet or range-bound markets. Moving averages excel in trending markets. MACD works beautifully during transitions, when a trend is beginning or weakening. Each indicator is strong in the right conditions, which is why traders rarely rely on only one. In the next page, we will explore how to use indicators responsibly, ensuring you build smart habits and avoid common mistakes. Page 6. How to use indicators responsibly. Technical indicators are most powerful when used with discipline, patience, and strategy. Many beginners misuse indicators by treating them as prediction tools, expecting them to forecast price direction with certainty. In reality, indicators work best when they confirm what price action is already showing. Best practices for using indicators. 1. Use indicators for confirmation, not decisions. Price action should always come first. 2. Avoid stacking too many indicators. This creates conflicting signals and slows decision-making. 2 to 3 indicators are enough. 3. Match indicators to your trading style. Scalpers may prefer fast MAs and short-period RSI. Swing traders may rely on MACD and 50/200 EMAs. 4. Always check higher time frame context. Indicators read differently on different time frames. Buy signal on the 5-minute chart may go against a strong daily downtrend. 5. Backtest your indicator combinations. Never rely on theory alone. Study past charts to see how your setup performs. Psychology and indicators. Indicators help remove emotional bias by providing objective measurements. However, over-reliance can create dependency, preventing traders from learning true market structure. The goal is balance. Indicators should enhance your analysis, not replace your judgment. In the next section, we will explore Fibonacci retracement and extensions, one of the most respected tools in technical analysis, used by both retail and institutional traders to identify key price levels, pullbacks, and targets. Section 5.2. Fibonacci retracement and extensions. Page 1. Introduction to Fibonacci in trading. Fibonacci analysis is one of the most widely used tools in modern technical analysis. Named after the 13th century mathematician Leonardo Fibonacci, the Fibonacci sequence is a naturally occurring numerical series where each number is the sum of the two before it. What makes the sequence extraordinary is that it produces ratios that appear constantly in nature, from seashells to galaxies, from plant growth to human anatomy. Traders believe markets behave in similar harmonic and repetitive ways. Although Fibonacci numbers themselves are interesting mathematically, trading focuses on the ratios derived from the sequence. These ratios, 23.6%, 38.2%, 50%, 61.8%, 78.6%, and extensions such as 127.2%, 161.8%, and 261.8% are used to map potential support, resistance, pullbacks, and target zones. In Forex trading, Fibonacci tools help answer several crucial questions. 1. Where might price pull back to before continuing the trend? 2. Where might a reversal find temporary resistance or support? 3. Where might a trend extend once it breaks new ground? These questions are essential because price rarely moves in a straight line. Markets move in waves, impulsive pushes followed by corrective pullbacks. Fibonacci tools help traders measure these waves. The two key tools are 1. Fibonacci retracement, which helps identify pullback levels during a trend. 2. Fibonacci extension, which helps predict profit targets or continuation zones. It is important to note that Fibonacci tools do not predict movement. Instead, they help traders visualize high-probability areas where price may react. They act as decision zones, not signals by themselves. When combined with support/resistance price action indicators, Fibonacci levels often become powerful confirmation tools. This section will explore retracements and extensions in depth, showing how to draw them correctly, interpret their levels, and use them in real market conditions. Page 2, How to Draw Fibonacci Retracement Properly. Fibonacci retracement is used to measure how deep a pullback might go within an existing trend. The key to using this tool effectively is drawing it correctly, which requires identifying the swing high and swing low of an impulsive move. In an uptrend, you identify the swing low, the lowest point before the trend began moving upward. Identify the swing high, the highest point the market reached before pulling back. Drag the Fibonacci retracement tool from low to high. In a downtrend, you reverse the process. Identify the swing high, the top of the move before the drop. Identify the swing low, the lowest point reached before the pullback. Drag the tool from high to low. Once applied, horizontal Fibonacci levels appear across the chart. The key retracement levels most traders use are 23.6%, shallow pullback, often seen in strong trends; 38.2%, moderate correction; 50%, psychologically important, even though not a Fibonacci ratio; 61.8%, the golden ratio, one of the strongest levels; 78.6%, deep retracement that still maintains trend potential. Price often reacts to these levels because they represent zones of institutional reentries, profit-taking, and waiting orders. For example, if euro to US dollar rallies strongly, then pulls back to the 38.2% level and prints a bullish reversal candle, this may indicate trend continuation. If price retraces deeper, towards 61.8%, it may signal a more complex correction, but still not necessarily a trend change. However, Fibonacci levels should never be used blindly. They are most effective when combined with chart structure, support/resistance, trend direction, candlestick confirmation, indicators such as RSI or MACD. Drawing accuracy is essential. Two traders can draw Fibonacci differently and get different results. Mastery comes from practice and understanding price swings clearly. Page 3, Interpreting the Key Retracement Levels. Once the Fibonacci retracement tool is drawn correctly, the next step is interpreting how price interacts with these levels. Retracement levels reflect probability zones where price might pause, bounce, or reverse. They do not guarantee outcomes, but guide expectations. 1. The 23.6% level. This is a very shallow retracement. When price pulls back only to this level, it suggests a strong, healthy trend with minimal correction. Traders see this as a continuation signal. 2. The 38.2% level, a common retracement zone. Many trending markets respect this level before resuming their direction. For swing traders, this is often the first pullback entry zone. 3. The 50% level. Although not a Fibonacci number, it is widely respected. Markets often retrace half of a recent move. It reflects balance, half retracement, half continuation. 4. The 61.8% golden ratio. This is the most important retracement level in trading. Many institutional traders watch it closely. A strong reaction at this level can lead to significant reversals or continuation. 5. The 78.6% deep retracement. Deep retracements can still maintain trend structure. This level is often used by advanced traders to catch late entries. Market behavior around Fibonacci levels. When price approaches a Fibonacci level, common reactions include a bounce or reversal, a consolidation, a false breakout, followed by continuation, a full retracement into the next level. The strength of reaction depends on trend strength, volume, session timing, economic news. This is why traders rarely rely on Fibonacci alone. When Fibonacci levels align with horizontal support/resistance, trend lines, or moving averages, the zone becomes significantly stronger. The next page will explore Fibonacci extensions, the tool used to project future price targets. Page for Fibonacci extensions for target projection. While Fibonacci retracement measures pullbacks, Fibonacci extensions project where price might move next, especially when it breaks beyond previous highs or lows. Extensions help traders identify profit targets, trend continuation levels, and potential exhaustion zones. Common extension ratios include 61.8%, 100%, 127.2%, 161.8%, the golden extension, 261.8%. To draw Fibonacci extensions, identify a swing low, identify a swing high, identify the end of the retracement. The tool then projects extension ratios beyond the swing high. Interpreting common extension levels. 1. 100% extension represents a move equal in size to the previous impulse, often used as the first profit target. 2. 127.2% extension, a moderate continuation level. Many breakouts aim for this zone. 3. 161.8% extension, one of the most respected continuation targets. A strong trend will often reach the zone before pulling back. 4. 261.8% extension reflects extreme momentum, often reached in markets driven by news or strong institutional flows. Professional traders use Fibonacci extensions to set take-profit zones, identify potential reversal points, estimate trend exhaustion, build risk-to-reward ratios, plan scaling out strategies. For example, after a bullish retracement to the 38.2% level, traders may aim for the 127.2% or 161.8% extension. Extensions act like invisible resistance lines in an uptrend or invisible support lines in a downtrend. The next page explains how to combine retracements and extensions for advanced analysis. Page 5, combining retracements and extensions. Fibonacci analysis becomes most powerful when retracement and extension levels work together. This combination helps traders understand where a trend is pulling back to, where the next push is likely to reach, how to plan entries and exits with precision. The typical sequence. A strong price move consists of impulse, retracement, and extension. For example, euro to US dollar impulsively moves up, retraces to the 38.2% level, and then rallies toward the 127.2% or 161.8% extension. This creates a clear, predictable wave structure. Confluence zone. Confluence occurs when multiple technical tools align in the same area. For example, 61.8% retracement near horizontal support with RSI oversold and a bullish candlestick pattern. The probability of a reaction increases dramatically. Risk management with Fibonacci. Fibonacci helps